we did see that number come across the tape Monday, and I think that kind of helped stabilize the trading at the beginning of the week. So those came in higher than expected. And the reason, like I said, that was important going back to what we were looking for this week, the week prior, was we've seen a lot of two things. We've seen a shift in the consumer going from good orders to basically experiences. So with everything in COVID, obviously you had quite a few individuals that weren't able to have kind of freedom of movement or freedom of experience, if you will. Now, we've seen the complete opposite shift of that now, heading into what is kind of what they're calling a post-revenge spend, where a lot of services are being consumed, experiences, the trips to Disney, everything that you weren't able to do during the COVID period, you're now going out and doing right now. So that would obviously affect the durable good order. And then also, like I mentioned prior, you do have a lot of double ordering and a lot of inventory management issues that have been going on because of all the supply chain issues during COVID, government shutting down factories, etc. So that number coming in Monday was actually positive for the market. Another thing I was looking for, and I ended up with egg all over my face on this one. If you remember the end of the video, I was very bullish on Micron heading into earnings. I thought a lot of bad news had been priced in. I figured 60 being a very critical level, a level that you'd see at its peak, its multi-year peak, prior to it breaking through that and ripping much higher during the COVID era with all the margins they were having during the chip shortage. I personally thought we would have issues with inventory and reduction in consumption of chips, whether it be memory. I mean, everyone knows that the cell phone and laptop market has softened. You can look at NVIDIA stock price. You can look at all sorts of leading indicators that have shown that this to be the case. So there was nothing surprising there. I think that was already factored in. What I don't think was factored in was on their call the extent to which that they mentioned they're looking to see a reduction in demand for their product. Now, some people are saying that's kind of like a bullwhip effect, where to the over ordering side, and now they're going to overcorrect and not only order less than what they need, but maybe even shoot to the cautious downside. I foresaw maybe that happening a little bit. However, if you look at their quarter, there's no way to cover up. It was bad, their guidance. They're cutting 20% to revenue and almost 40% to GAAP EPS, which was obviously a major blow. I was actually surprised the price action of the stock following the news. On a day like that, especially if that happened a few months ago, you would have seen double-digit price decline action. You actually saw price decline actions of under 5%. Now, obviously, leading into the print for the earnings, the stock was down that day as well. But even still, you're looking at a relative 1 week kind of high trading range recently of 60. Flip side of that, looking at the price action this week, I think it actually, in spite of the massive cut to revenue and your GAAP earnings going forward, you still had solid, in my opinion, in the face of that, pretty decent price action. Obviously, it was still negative. You don't see any sort of rallying into bad price action, which is a very bullish sign when you have negative news and good price action. I don't think we're there yet. I think the tape is basically telling you we still have some time to go on this one. I was maybe a little preemptive on my bullish call on that. But good news moving forward is they're basically trading at book value now. They bought over $1 billion worth of common stock last quarter, and in their conference call, they made very clear that they plan on still being aggressive in share repurchases. So while I don't really see much of a positive catalyst going forward for the next few months on this one, I do not see. Now again, I'll put my hand in the air, say I've been bullish at higher levels than what we are right now. But with that kind of very aggressive share repurchasing, I don't see a whole lot of downside risk. I would say your downside risk from these levels, you're probably looking at maybe, I would say roughly 15%. I think the 50 level is going to be somewhat important on the stock. I don't see it breaking through the 60 level, which is what I was looking at prior. My positioning was such that I actually thought I was going to break through the 60 and head to the 70. And even leading up to earnings, you had some massive call buying of the $60 strike. There's one single individual that purchased over $300,000 worth of the Friday expiration. So what would be now expired options as if you're listening to this, but the Friday expiration $60 call options. Obviously, someone was betting very heavily that it would break through the 60 resistance and maybe push all the way through that air pocket up to 70, or maybe even just have a 50% Fibonacci retracement up to 65 level. Obviously, those hundreds of thousands of dollars of call options that were purchased, I believe it was Wednesday, expired worthless on this one. So I was definitely wrong. I saw some price action that I thought would actually validate a ride into the earnings and following the earnings on Friday, and that was just not to be. The news going forward on the earnings call was just far too negative. Price action, all things considered, wasn't horrible, but you still traded downward, and I don't see that trend breaking anytime soon now. I don't see any catalyst in the next couple months to stop that downward trend on Micron and kind of more generally speaking the semi industry as a whole. We also did have Nike. Nike was one that kind of followed the script a little bit better, if you will. You had them come out for earnings, and I kind of figured this would be a market mover. Again, just like Micron, they beat on their earnings. But again, the issue with Nike was their guide. Getting to Nike specifically, I do think if you're looking at this long term, the $100 level is a very critical level. And I think if you were getting at roughly that level, it would not be the worst investment decision. I do, however, foresee that they're going to be, again, under pressure over the next few months. But I think the good news with Nike, especially at the $100 level, they spent many years investing in tech. Everything from NFT space to production to basically their entire execution. So I think those kind of years of investment, they're going to start to enter what we would consider a harvesting phase, where they're going to start seeing an increase in their margin and an expansion in their bottom line earnings because of they're going to be harvesting on those tech investments that they made in the prior years. Nike, following the tape a little bit better. Micron, that was a swing and a whiff on that one. And then another market mover that we had was the ISM PMI on Friday. So that came in worse than expected. And the reason that's important is because that is kind of what you would consider, in the industry, we consider a leading indicator. So this number basically measures and quantifies the demand for inputs. And these inputs are obviously used in manufacturing. So the higher the number, that indicates the higher demand for manufacturing, which again is going to filter through on your end consumer or your end product. So obviously if you're not manufacturing a lot, your demand for these units will basically be lower. And again, we saw that on Friday, and that was registering the June manufacturing PMI that registered at 53%. That was down over 3% from the reading in May. So that's not a very good forward-looking guide, if you will, and a forward-looking indicator. You're seeing a 3% month-over-month decline. And if you go back, even just a couple months prior to that, it was registering even higher. Now, again, the market we're in right now is kind of finicky, where sometimes bad news is being treated as good news because the investors are viewing this as, all right, so that's going to ease kind of basically your pricing pressures. It's also going to ease your supply chain constraints, and that might actually make the Fed's job easier for them than what it is. So it's kind of right now where you're sitting in the market where occasionally bad news will actually be taken in as good news, because that means the Fed's job will become easier and the unwinding of these issues that we're having with the supply chain and everything might not be as difficult as one was anticipating. If you look at Friday where we closed, this 3,800 level has been kind of key the last couple weeks. Again, we closed above that level. That's important for a couple of reasons. One, where we're sitting at right now on the S&P 500 on the market overall is roughly where we were 6 weeks ago. So there's been a lot of volatility from a month and a half ago to now, but the actual investments, S&P 500, these indices are actually sitting at levels where they were 6 weeks ago. So the reason that's positive is we kind of had an obvious bearish decline, and where what some individuals are predicting is that we're kind of maybe going to enter some sideways chop. So instead of heading an embarrassed descending decline where you're one step forward, two steps back, this 3,800 level has again provided kind of key support. And the fact that we closed above it on Friday, in spite of the fact that we saw some rough data that we just discussed as far as the ISM PMI, I still think we in the short run could be seeing 5% upside or maybe a little bit more. I think the 4,000 to 4,100 level S&P I think is the level that we could potentially be targeting in the short run. So that's kind of a recap of where we were last week and what was going on. Now, looking ahead, this week, obviously Monday's market's closed, so it's going to be somewhat of a shortened week. We don't have any major earnings like we did as far as last week, with Nike kind of being a barometer for the consumer discretionary sector. And then we also had Micron, which was not the biggest of the semi, but one of the large mega cap semis that was reporting. And again, that not to harp on it even more, but their guide was very, very poor. This week, we don't really have any major bellwethers that are going to be reporting. You do have Levi on Thursday. So again, if you're kind of looking at consumer discretionary, that's going to be one to pay attention to. We do have the ISM services PMI on Wednesday. I think that's going to be kind of an important reading, because what I was mentioning earlier as far as the market potentially taking bad news to potentially be good news, this ISM services number, you have started to see deflationary pressures on the goods front. So Target, Walmart, all these guys are obviously slashing prices. Housing has not, even though it makes up a big component of the inflation data, housing has not really seen a whole lot of pressure as of yet. But you still have seen inflationary pressure in the services sector. So if you think of airline tickets, you think of a lot of these kind of the service industry, if you will, you've still seen inflationary pressure, which again is making the Fed's job a little bit more difficult because they want price stability. So on Wednesday, you're going to have the ISM services PMI come out. I believe that's a very important number. Should definitely be keeping an eye on that. You also have your unemployment rate on Friday to end out the week. Again, this is kind of one of those is bad news, good news type thing. The Fed right now is saying that they're exclusively focused on price stability, inflation. Can they be believed? That's the $1 million question. Is the Fed actually going to stick to that? You have that it's going to be one of many jobs reports. I remember if you go back to the recession in 2008, really started in 2007, all the way kind of like to 2009, every Friday, you had the market that would fret over the jobs report. Now, obviously, we were in a period of very high unemployment, and that was a indicator that the market was very concerned with, because as you started to see jobs added, activity continue and regain, the market knew that was bullish news. So this time around it's a little bit different. It's not going to be the key focus, I don't believe, as much as inflation and some of these other data readings. But if you start to see the unemployment rate become uncomfortable, and I'm not talking 4% or maybe even 4.5%, but if you start to see the unemployment rate aggressively approach very quickly 4.5%, will the Fed still continue the work of price stability, or will they waver? I don't really know how much credibility they have, so I'm in the camp that believes that they don't have two legs to stand on. They wavered in 2018. They wavered in 2020. Why will they not waver again in 2022? So that's another thing to kind of keep an eye on. That's rounding out your week. Again, you have the PMI Wednesday for services. Thursday you have Levi. Friday you have the unemployment data. Another thing I'll be keeping an eye on is you have mega cap movements. So if you look at last week, S&P was off 2.5%. Not bad considering the week prior. It was up roughly 6%, I believe. Now that's important for two reasons. One, a lot of these mega caps have a very heavy weighting in the S&P 500. So if for them to be lower than the market, especially significantly so, that means there's definitely major selling pressures. And the reason that's important is because these are the companies that no one wants to sell. You know that no matter what happens, come hell or high water, these guys are going to be around. I'm talking about companies like Apple, Google, Microsoft. They have so much cash available to them that no matter what happens over the next 12, 18 months, whether the Russia war evolves, it doesn't matter. These guys will be around. They could literally shut up shop for 12 months, tell everyone to take a holiday and still be around. There's no solvency issues with these companies. It's just a matter of what price are you willing to pay for the stability and the growth. Now, if you look at the S&P again, down 2.5%. Microsoft for the week was off 3.25% roughly. And one that was even more and flagrant, and this is the one that really caught my eye, Google was off 8% for the week. Okay, so you're talking Google, one of the most important, largest, influential companies in the entire world, that was off more than 3 times what the S&P 500 was for the prior 5-day period. Okay. And the reason that caught my eye, the last companies to be sold in a bear market typically are the ones that the people, investor community loves the most. Your Apples, your Googles. So if you think about kind of the big 5 names that everyone was talking about prior to coming into this, the end of last year and the beginning of this year, you had Apple, you had Google, you had Microsoft, you had Tesla, you had Facebook. These are kind of the large mega cap companies that everyone was investing in. It didn't matter to your news network. They were a surefire bet, right? And there's reasons for that. Again, like I mentioned, they're the ones that nobody wants to sell. However, typically what happens on the way down, they're the last ones to be sold and the first ones to be bought. So if you continue to see weakness in Google, if you continue to see weakness in Microsoft, and maybe some weakness in Apple, might that be kind of the last leg down for the markets prior to us maybe seeing a better second half of the year? My bet would be that that's potentially so, depending on where we're ending up in a few months period, and what kind of the Fed says. But you're beginning to see these names crack, and that's something to very closely watch. The last thing that we had last week that we're going to kind of be looking ahead towards this week is crypto. Okay, so last week you had very, very high volatility, and you also had liquidations, and you had margin calls as well. Three Arrows Capital was in the news all over the place. You had a default on a $350 million loan. They were also unable to make a margin call to BlockFi, which was very interesting because BlockFi in and of itself was possibly being bought for $25 million. So you have, again, and this kind of gets back to if you're around in 2008, the CDO market, basically what was happening where people were taking securities and repackaging and selling those securities and basically levering up. So they would take a whole bunch of houses, slice them into a million pieces, and say, all right, we're going to give you 1% of the revenue flow of this. And then they would take the second derivative of these things, and they would make complex financial instruments that were essentially backed by something that was backing something else, that was backing a piece of paper that was backed by a mortgage. So you had basically money following money in a very aggressive manner. And I think we might start to see this with the crypto industry. Again, Three Arrows Capital, we're not talking about a small, money pool, if you will. They defaulted on $350 million loan. BlockFi obviously is very well known, and they themselves might be being bought by $25 million. And you also had Celsius and CoinFlex halting withdrawals in their accounts. So you had all that happening last week. And I think if you're looking ahead to this week, where does the rubber meet the road? Okay, so as far as the equity markets go, you have a couple companies that are highly exposed to the crypto markets, but that are trading on equity exchanges. So one that is the most obvious and comes to my mind is MSTR. And the reason I'm bringing these guys up is because they've been buying Bitcoin not with their own money, but also been borrowing money and using debt to basically finance their purchasing of crypto assets. Now, they've come out and said that they don't have any liquidation issues, that they are more than able to meet margin calls. However, no company obviously is going to publicly admit that they're not liquidated or that they're not capitalized enough to meet margin calls, and they are going to be able to avoid liquidation. So again, this kind of gets back to where we're seeing similar activities in the crypto market last year and a half that we saw kind of at the end of the financial bubble that occurred in 2008. So they've basically been using Bitcoin to borrow money to buy more Bitcoin, which is great if Bitcoin goes higher. However, like I mentioned earlier, they're already below their average purchase price. They have not been buying any more Bitcoin. $20,000 seemed to be the level where if they cross below that, they actually might get margin called. Now, if Bitcoin were to head to 19,000, I think they should be all right. However, if Bitcoin were to head towards $15,000 or $10,000, you could potentially see MSTR be forced to enter or to exit coins from the market. Now they're selling, because they are one of the largest holders of Bitcoin in the entire world, they're selling would obviously beget more downward pressure, which would potentially involve them with even more margin calls and potentially involve them what's considered like a death spiral, if you will. Obviously, they have become essentially what is a proxy for Bitcoin. If you go back to early May, I mean, this chart's absolutely brutal. Going back to early May, you're trading at 275. You had massive block negative volume downwards to roughly the 168 level. I mean, it traded all the way down a little bit above 150, but you had massive negative pressure down 168 level or so, which is roughly where it's at today. Double top up to 275, and we drop back again to 150. I think you might see this thing run to 200 potentially in the short term. Again, they are very highly levered. If you look at MSTR specifically, getting back to kind of the fundamentals of the company, these guys own Bitcoin at roughly 30,000 a coin. So obviously Bitcoin right now is traded around 20,000. So they have roughly 30,000 Bitcoin trading that they own 50% higher than what it's currently trading. Bitcoin as of close was $19,000. I think you could have a situation here where they're going to start to see margin calls because they use Bitcoin to acquire debt to buy more Bitcoin. What they have already tethered to that debt and already promised, I don't believe to be enough. And I continue to see pressure down for Bitcoin, potentially down to the 15,000 level. 10,000 would be a massive level. I don't think it could break below that level. I think for Bitcoin to break below 10,000, we'd have some serious issues macroeconomically speaking. It's just based simply on the demand for the product. So the floor is 0 on this. However, that being said, going back to MSTR, the 130,000 coins that they have, they're already massively negative on. I do think that you're going to start to see margin call pressure, even though Michael Saylor, who's the CEO, has kind of dismissed and said they're going to pledge more Bitcoin. I don't really know how much they have available that's not already pledged as collateral for their debt. And if you start to see cracks in some of these other DeFi projects and stuff like that, like we did last week, I don't see any positive news heading to this equity coming up. So again, if you're currently sitting in this equity right now as we're speaking, I think as ugly as it might get, if MicroStrategy approaches 200 and the S&P kind of rallies to 4,000, I think at the 200 level you seriously have to consider potentially walking away from it until the news changes. So going back to MicroStrategy, for me, that's definitely a dump all day long until something fundamentally changes. The moving average is downward sloping. The chart isn't able to seem to find any support. Every time it seems to find a support, it breaks through it. The only one of relative note is kind of like that 150 level. And I don't foresee it holding that if you begin to see Bitcoin break down even lower. I think it'll take out that low as well. So again, MicroStrategy dump. Another one I'm looking at, a little more positive news. We're going to be looking at one that's Citi. So in the banking sector of equities, you kind of have what they call the investment banking kind of community, kind of like the money center banks. Money center banks are kind of what you consider as your more traditional Bank of America, Wells Fargo, Citi, etc. So with Citi, I'm kind of going to begin to actually flirt with this one. I think when you actually look at and this kind of goes back to what we touched on in the earlier video with the Fed doing the stress test, these banks are much better capitalized than they were in 2008. I know everyone's knee-jerk reaction is to go back and say, all right, if we're heading into a recession, what would the last one look like? Because that's the playbook. It doesn't work that way. In the late 90s, tech was what led us farther south. In the kind of beginning 2008, end of 2007 era, it wasn't tech at all. It was actually the financial system that was leveraging the housing market, and every single American leveraging everything they had in the housing market as well. So kind of every session you kind of see similar patterns of play, but there tends to be different winners and losers as far as categories and groups go. So I don't think the banks are going to do as poorly as everyone thinks, even if we have a recession. I think it'd be more kind of like the mid-90s, where they're very highly capitalized. They're very well insulated, in part because the Fed and the government have been monitoring and forcing them to be. But getting back to Citi specifically, if you look at the chart, it's kind of been forming a bottom here around the 46 level. Right now, that's roughly where we're trading. A massive percent of the float of the equity shares themselves is actually being purchased by Warren Buffett himself. I don't foresee any massive potential upside over the next 3, maybe even 6 months in this company. But right now they're having a dividend that's yielding over 4%. So you're making over 4% on your money while you're sitting around and waiting. Your 52-week low, again, you're looking at roughly a little touch hair over 45. So from where we are to the 52-week low, I think there's kind of good support. You can go back all the way to May 12th, and we're essentially trading at the levels we're at now. So we've kind of had this bottoming process and this level of support here in Citi. So as far as Citi goes, that's one where you're yielding over 4% on dividend alone. I think the CEO and Jane Fraser is going to do an excellent job turning this company around. It's going to take a while, but while you're waiting, you're making a little over 4% on your money. And I think the downside risk will be limited here. So that's one I'm looking to get in, establish a position. If you're not in any of the money center banks, I think this is a good one to get into and dip your toes into as well. Now on the flip side, if you're looking kind of staying on the bank theme, you also have kind of what are the investment banks. As far as the investment bank goes, Goldman Sachs is obviously one of the most renowned names in all of banking. These guys are one of the top dogs on Wall Street. They know Wall Street like the back of their hand. And even if the market goes down, I think they're going to trade their way out. You know, the IPO market and some of these other markets that are huge chunks of the revenue are obviously going to be down massively. The IPO market has basically kind of gone into hibernation and waiting for the bear market to be over before you see new listings. Obviously, that hurts Goldman Sachs. That's one of the reasons that it's traded off from 400 all the way down to 300 where it's at over the last 6 months. Don't kid yourself. These guys, again, still profitable. They're yielding 2.6%. And I definitely like the management. And one thing a lot of people don't understand with these investment banks that aren't necessarily in the sector. So the way these guys work is in a time like now where yield and returns are becoming more difficult, a lot of your senior management will take their money to the bank, go to the Hamptons, and kind of just sit out for a couple of years because, you know, they've been making 7 figures a year when times are good, and they don't want to deal with kind of the situation and the churn and the difficulty of managing through a period like this. So what that means is you'll start to see a turnover of the upper management and mid-management and the people that they're bringing in. And again, a labor cost is for these guys is very, very large because you have to hire the best people. In order to hire the best people, you have to pay them the best. So your labor costs on a company like this, you're looking at roughly anywhere around 50%. But with the environment we're in, that's going to be artificially deflated because you're going to have deflationary pressures on the fact that some of these guys are just going to be taking their checks and walking away. And the young blood that's going to be coming up through is going to be cheaper and is going to be hungry and is going to be taking their spots. So that's beneficial for Goldman. The guys who are leaving were on higher salaries. The guys who bring in and replace them, lower salaries. Very simple deflationary pressure on their cost side. All the while, I think that these guys can manage and trade through an environment like this as well as anyone else, bar maybe Blackstone. So sitting here at 300, I think this is a great play. I mean, you can get in here and you're 30%, more than 30% off the high. And again, you're yielding 2.6%. And if you want to fatten that yield, maybe you can even sell some cover call options against your equity position on that one as well. So again, this is one I'm definitely looking to date as well in this market environment. I think it's a good way to go. Last one we're going to look at for the week going forward, we kind of mentioned earlier as well, is going to be Google. So Google, again, is one of the kings of the market. They're one of the companies that everyone you talk to, they look at it as a cream of the crop, an excellent, well-run company that, barring macro situations, is going to do well. And in spite of sometimes macro situations, might even still continue to do well. You had it during its peak, kind of in the end of last year, multiple times kind of trade up to that 3,000 level and fail. Right now you're sitting at 2,200. I think this is one that you kind of begin to flirt with. I think the key level you're looking at is 2,000, so that would be a double off of the COVID lows. And that would kind of make sense as far as a pullback goes. You got a little bit of support at 2,000 levels. That was first hit all the way back in February 2021. Okay, pre-COVID level, you're looking at 1,500 after that. Where it's at right now, you're trading at 21.75. I would definitely not be shorted, but I would definitely begin to kind of flirt with the idea of maybe acquiring this if you don't have a position already. Maybe starting to acquire a position around the 2,000 level. Again, you are going to also have a positive catalyst going forward. They are going to be doing a share split, so I do think that you kind of have a catalyst in the future that you can attain for that will definitely kind of be a little bit of a boom for the stock, and that's going to be a 20-for-1 split coming up here in a couple weeks in July 15th. If you don't already own a position, you maybe define your levels and you start to flirt with it, knowing at this level I might want to date it. We'll see how this goes. All right, so that's a wrap. Covered 4 equities today: MSTR, Google, Citi, and Goldman Sachs. Hopefully you guys have a great week. Enjoy your 4th of July, and until next time. Review, guys. Co-host has COVID, so kind of improvising again this week. Doing our best with all the technical issues with all that surrounded.